Hi, good afternoon, everyone. My name is Gerald, and I am a CR speaker on investor education, and I will be the moderator for today's session. Thank you for joining us today for this dialogue with Manulife US REIT relating to two resolutions on the disposition and acquisition mandates to be tabled at the upcoming EGM. To give a very brief background, the proposed resolutions for the upcoming EGM relate to two key mandates. The disposition mandate allows the sale of up to three existing properties with net proceeds of up to 350 million US dollars, and each property sold at no less than 90% of its latest valuation. The acquisition mandate permits investments in new assets with a total value of up to 600 million US dollars, each capped at 110% of its valuation, funded with no more than 40% debt, and approved by all directors. Together, these mandates are intended to provide a more disciplined framework for recycling of assets, diversifying the portfolio, and enhancing long-term value for unit holders. Today, we are very pleased to have with us the senior management of Manulife US REIT to join us to discuss the rationale of this mandates. So thank you, John and Mushtaq, for being with us here today. We'll kick off the session with a presentation on the overview as well as the rationale behind this mandates. So without further ado, I'll hand over the time to the senior management of Manulife US REIT.
Thank you very much. And good afternoon, everyone. And thank you for attending our briefing on Must Growth and Value Up Plan. I'm sure by now you are familiar with our strategic roadmap, comprising of the three phases of stabilization, recovery, and growth. Under the stabilization phase, we have made substantial progress, having raised, sorry, I got something on my screen. Never mind, it went away. Having raised, sorry guys, I had a little problems there. Having raised 273 million from divestments of Capital, Plaza, and Peachtree, achieving 83% of the minimum sales target of 328.7. With net proceeds from divestments and cash from balance sheet, we have repaid 317 million of debt, with just 36 million of loans maturing in 2026. We are at a pivotal point in executing our recovery and growth plan, which we call the Growth and Value Up Plan. I will elaborate on this in the next slide. Even when the recapitalization plan was proposed in 2023, we never intended just to sell assets to pay down borrowings, but rather position ourselves on a path to growth for the long term. The Growth and Value Up Plan is about disposing assets that weigh down our balance sheet without meaningful upside potential, and using part of those proceeds to buy higher yielding, less capital intensive, non-office assets. Therefore, we would like to seek unit holders' support to position Must for recovery and growth. To that end, we have also negotiated with lenders for certain MRA concessions. The goal of the Growth and Value Up Plan is to revitalize the portfolio to improve its diversification and long-term value creation so that we can exit our MRA and resume sustainable income distributions as soon as possible. We have broadened our investment mandate beyond the U.S. office sector to principally invest in income-producing real estate in the U.S. and Canada, as well as real estate-related assets. Based on listing rules, we're required to provide 1 month's notice to investors on the change of our investment mandate, and no unit holder approval is required. In other words, the broadened mandate will be effective on January 1st, 2026. Our focus will be on industrial assets, living sector assets, as well as retail assets in the US and Canada. We aim to revitalize our portfolio through the sale of up to 3 office assets, with proceeds to be used to acquire new assets, repay debt, and fund capital expenditure, tenant incentives, and leasing costs. Our goal is to lower MUST aggregate leverage and provide a future runway for growth. Unitholders' support for the two resolutions is a critical part of MUST discussions with the lenders. We have negotiated with the lenders to grant certain concessions, namely a 6-month extension of MUST deadline to meet the minimum sales target of 328.7, a temporary relaxation of the unencumbered gearing covenant from 60% to 80% until June 30th, 2026, and bank ICR from 2 times to 1.5 times in December 31st, 2026. As of today, not all our lenders have obtained the necessary approvals to grant the MRA concessions, but we're confident they will. The remaining lenders are still in the process of obtaining their internal approvals based on their credit committee meeting schedules. 2 resolutions will be tabled at the EGM. Resolution 1, Disposition Mandate, which allows us to dispose up to 3 existing properties to raise not more than $350 million. Resolution 2 is the Acquisition Mandate, which allows us to make acquisitions and investments in one or more initial focus assets, not exceeding $600 million. Both resolutions are interconditional, which means they are linked, and unitholders will have to approve both for any of them to pass. In other words, you can't support one resolution and not the other because they are part of an integrated plan where divestment proceeds are used to pay down debts and recycled into the assets I've already outlined. More specifically, how does growth and value up plan benefit MUST and its unitholders? Firstly, it enables MUST to revitalize its portfolio under the broadened investment mandate. A diversified portfolio enhances cash flow stability against market volatility and sector-specific challenges. It gives MUST the strategic flexibility to grow its portfolio and increase long-term returns for unitholders. Secondly, it gives MUST a competitive advantage as a seller and a buyer as we pivot into other asset classes, since speed of execution certainly are critical to achieving best outcomes for unitholders. Not having to conduct an EGM for every transaction will help to reduce administrative time and expenses, and in a competitive market, reducing the risk of losing the deal because others could act faster. This is key for us to achieve the best pricing for both acquisitions and dispositions. Thirdly, we are making acquisitions at leverage ratios of 40% and below. This will help reduce our aggregate leverage, improve cash flow and credit profile, and pave the way for us to exit the MRA. There are some of the key terms of the disposition and acquisition mandates. Safeguards have been set in place under these mandates to ensure discipline when we dispose of and acquire assets, to ensure they are conducted in a manner that is in the best interest of the unitholders. Notably, in order to improve our ICR and leverage, the acquisition mandate requires that ICR of each acquisition must be 1.6 times so long as MUST aggregate leverage is more than 50%. Under the mandate, acquisitions must be funded with 40% debt or less, and if additional debt is taken, the aggregate leverage has to decrease post-acquisition, and the total debt incurred should not exceed $800 million in total. For your reference, as of September 30th of this year, MUST aggregate leverage was 56.2, ICR 1.6 times, outstanding total debt was $559 million. As mentioned earlier, we have a broadened our investment mandate to revitalize the portfolio and to explore other asset classes beyond office, such as industrial, living sector, and retail assets in the US and Canada. We believe that these asset classes offer attractive yields, lower capital expenditure requirements, and/or increased capital appreciation potential, and would help with future refinancing efforts. A diversified portfolio helps to hedge against market volatility and sector-specific challenges. We also selected Canada as a new market, given its strong alignment with the US real estate fundamentals, as well as the sponsor's established local presence in Canada. Generally speaking, the initial focus asset subsectors offer higher yields, lower capital expenditure requirements, more resilient growth prospects, and are better aligned with evolving market dynamics than office. Industrial assets exhibit one of the strongest risk-adjusted yields due to firm capitalization rates and demand growth fueled by structural tailwinds such as nearshoring and evolving supply chains. They also generally see lower turnover and lease-up costs, as tenants are more likely to renew given these assets' strategic locations and functionality of the buildings that benefit the tenants to be more efficient in their operations. This shifts the leverage to landlords when negotiating leases and allows these tenants to be more sticky come renewal time. Also, I'd like to point out that these leases are typically triple net, which means the tenant pays for the taxes, insurance, and OpEx. So there's no risk of increase of expenses as it relates to the MPI of the property, as those are all passed directly to the tenant. Living sector assets, such as multifamily residential, also delivering high risk adjusted yields due to historical undersupply and resilient tenant retention. There is also a prevailing preference for home renting over home ownership in these markets, and their yearly leases renewals allow rents to be marked to market on an annual basis, hence serving as an effective hedge against potential inflation. Retail assets offer compelling risk-adjusted yields, historical low vacancy rates, robust rent growth, and resilient tenant demand. Grocery-anchored and experienced centers, in particular, provide stability across market cycles. These leases are typically triple net as well. As I mentioned before, the tenant would pay for taxes, insurance, and OpEx, so mitigating risk of potential expense increases over time. In this slide, we just wanted to share the expertise and experience that the sponsor, as well as the chairman and senior management of the manager, have in the industrial, living sector, and retail asset sectors. As you can see from the chart, Manulife Investment Management Real Estate, which oversees the assets for both the sponsor and third parties, manages a diversified multi-sector portfolio of investments comprising of office, industrial, living sector, and retail, spanning across the US, Canada, and Asia Pacific. We will be able to leverage the deep expertise on the ground capabilities of our sponsor Manulife as we make inroads into these new market sectors in the US and Canada. Mushtaq, the CFO, and I have combined close to 60 years of experience in these sectors. We would therefore like to urge unit holders to give us their support so that the management can unlock new opportunities for growth through recycling office assets to acquire higher yielding assets and increase long-term returns for unit holders. As mentioned earlier, receiving this support would be instrumental in obtaining lenders' MRA concessions. This will give us more time until June 2026 to meet the minimum sales target, and together with the growth and value up plan, will pave the way for us to exit the MRA. The disposition and acquisition mandates will also enable us to act quickly to seize and execute on dispositions and acquisition opportunities to achieve the best outcomes. Sales proceeds can then be efficiently recycled into acquiring initial focused assets to revitalize the portfolio, repay debt, and fund other working capital needs. Furthermore, since one of the conditions for us to exit the MRA is to bring our ICR and aggregate leverage to healthier levels, acquiring properties at lower leverage ratios will also improve MUS's cash flow, credit profile, enabling us to resume sustainable cash distributions supported by a more resilient portfolio and cash position. To this end, our directors have recommended that unit holders vote in favor of both resolutions. All directors who hold units in MUS will be voting at the EGM in favor of both Resolution 1 and Resolution 2. Both Resolutions 1 and 2 on the disposition mandate and acquisition mandate, respectively, are interconditional, meaning unit holders need to support both resolutions. If both resolutions are approved at the EGM and the lenders grant the MRA concessions, it will give us time to meet the minimum sales target. We will also be able to execute the growth and value up plan to revitalize MUS portfolio. However, if either of the resolutions fail to obtain unit holders' approval, not only may lenders not grant the MRA concessions, they will also have the right to accelerate payment of all of the $559 million of loans immediately after December 31st, 2025. And MUS will be at risk of liquidation of its portfolio at distressed prices to meet these obligations. This slide shows some important dates relating to the EGM to take note of. Our EGM is scheduled for December 16th. This brings me to the end of my presentation. I will hand it back over for a Q&A session. Mushtaq and I will be happy to take your questions.
Thank you for sharing the update. So we'll go into the Q&A session. For participants who have joined us today, you can submit your questions in the Q&A box, and I'll be taking those questions and asking the management team of Manulife US REIT. In the meantime, we have some pre-submitted questions that we will start today's Q&A session first. And I think the first question would be relating to disposals. So the question would be, instead of disposing existing properties, has management considered repurposing or renovating them for alternative uses, such as hotels or service apartments? Could partial conversion actually unlock higher rental income or future valuation?
Yes, so that's a great question. So I'll give a little bit of an overview. So we continually, since day one when we joined, have looked at every option possible for the portfolio. We're constantly looking for liquidity within the portfolio and anything we can do to create value, in addition to what was just mentioned. And so with repurposing assets, it can be a little tricky. I know what seems to be out there makes it seem very easy, but repurposing an asset for multifamily or hospitality has a lot of very specifics that need to come in play as far as where the building is located in the market, to where it is in the submarket, to where it is on the block, to the configuration of the asset, the size of the floor plates, the window lines, etc. So there actually is a building that we've been working on now for a while and have been in discussions with a potential group that would work with us on this. It's one of our smaller buildings. It's one of our older buildings. And we're in discussions with them on the feasibility. So far, it looks like it has potential for feasibility to convert to multifamily. So we are absolutely looking at this, but at this point, we only have one building out of the portfolio, out of the 7, that would align for that potential.
Okay, jumping to some of the live questions that are related to disposals or asset sale. This question by Mr. To. The asset sale appears to be slightly behind schedule. Does this imply market weakness and likelihood of even more depressed NAV and asset sale value in the first half of 2026?
Yeah, so that is we are behind, and it's not due to a lack of effort. We are behind due to a much slower recovery in the office market in the US. When the MRA was originally put together in December of 2023, the structure of the MRA was thought that the office market would improve much quicker than what we've encountered. So based on that, we are behind. It has been extremely challenging to sell assets up to this point in the US. We have sold 3 assets. When the MRA was constructed, I think by concept, the 3 assets we would have sold, we would have been able to meet the 328.7. However, we've done everything we can to get as close to that number as possible, including coming off the balance sheet, which got us to 317, even though it doesn't meet the exact requirements of the MRA. But we did get 83% to that number. Our lenders have taken note of the efforts that we've made in addition to coming out of balance sheet to pay off our debt, which is why we have been successful with these conversations with the lenders as it relates to the concessions I've outlined, and also why the lenders feel it's important for us to have this growth and value up plan. So that was the first part of the question. Yeah, as it relates to NAV, I mean, the slow recovery in the office market has had a direct influence, obviously, on valuations. NCREIF, which is a group that looks at values across the US, just to give some perspective. So NCREIF for office product for our type of office, which is majority CBD office, for last year, so 2024, NCREIF had reported that office valuations were down almost 17%. For this year, they're reporting office valuations down only 3.8%.
Okay, another related question to disposals. This question by Jeremy. Does the new strategy imply that we are not able to meet the previous disposal concession? Should we not focus on that before starting on a new plan?
Yeah, so yes, we're not going to be able to meet the December 31st deadline of the 328.7, which is why our lenders, as part of the lender concessions, has given us an extension to June 30th. We feel comfortable that between now and June 30th, that we will be able to execute on one disposition to meet the $56 million amount that we need to pay to meet this milestone. As it relates to the other part, again, I've mentioned this in the past. You know, we need to tie our dispositions to a growth plan. If we're simply just disposing of assets to pay off debt, we're going to end up in an unintended liquidation scenario.
Okay, so I think relating to that, what makes us think that achieving the disposal under this strategy will be better compared to the previous plan?
Yeah, that's a great question. So the original MRA was extremely prescriptive. I mean, it classified the assets from tranche 1, 2, and 3. On tranche 1, it gave the release pricing on it. It even gave the milestone dates of when this needed to be achieved. So essentially, it gave the buyers in the US access to this information, given it was all public, which made it extremely difficult in us negotiating deals. As an example, I'll mention, Peachtree. When we went into that negotiation, I mean, we had 5 buyers lined up to purchase Peachtree. Liberation Day hit, which was something none of us could have anticipated. We were lucky enough to have 1 buyer still interested in purchasing the asset. But again, that buyer had access to this information to know there was a June 30th drop dead date that we needed to make a payment to our lender. So again, the way we've structured this is not to provide so much details to put us at a disadvantage when executing in the market.
Thanks for that answer. In that case, have we identified the three properties for disposal? And what are these properties?
We have not identified those properties. There's one in particular that I can't name, but there's one in particular that we're working on now with an off-market buyer that is starting to take form. So there's one that's in the works. The other two have not been identified. But the other two, again, the goal is to maximize our ability to values on disposition side. So having that extra time to be able to do that is one, going to allow the market more time to recover, but also allow us to be able to find a more strategic buyer versus more of a clearing price scenario on a broader marketed situation.
And in that case, maybe moving on to the acquisitions, have we identified the assets to acquire?
Yeah, so let me give a little background on that if you don't mind, because it may answer some other questions down the road. So one thing I want to clarify, because it's come up on some of our previous calls. So none of the assets that we're anticipating on acquiring, which we haven't identified them yet, to be clear, but even at that, we're not going to be buying anything from the sponsor. So these are all third-party acquisitions that we're looking at. So there's no request in any of these resolutions for any IPG transaction. So I just want to make that very clear. We're not buying any assets. None of this is related to us buying assets from the sponsor. So these are going to be all third-party acquisitions that we're looking at. So having said that, let me just take a step back and describe the platform that we benefit from on the sponsors level. So Manulife Investment Management has a platform that spans across US and Canada that we would be utilizing. Our asset managers that manage our current portfolio sits on this platform. We have, in addition to our asset management team, we have transaction team that is located throughout the US and Canada that is dedicated to specific markets that they office and surround in. And so these acquisitions will be sourced through them. These acquisitions could also be sourced through my relationships within the US. And again, if it comes in through me, it'll be vetted and then handed off to the transaction officer that would cover that market. We have a weekly pipeline call, which what that means is every week the transaction officer's job is to find potential acquisitions, not only for us, but for the rest of the platform. So there's about 10 portfolios or funds that sit on this platform, the SREIT being one of them, and there's 9 others, let's say, and it's a fluid number, so there can be more because this is the majority of this is third-party business. So everyone sees these opportunities come in. There's a formal process for how these things are handled. So the SREIT has an equal vote, just like everyone else that sits on the platform, if there's something that is attractive and we want to pursue. So a transaction officer would find a deal. They would initially present it on the pipeline. If there's interest amongst the portfolios that would be expressed, the transaction officer would continue the process, do the further due diligence. And if, for example, it was an SREIT asset that we had identified we were interested in, the way the process would work is I would work closely with that transaction officer on the acquisition, which means that I would be involved in the underwriting. I would tour the asset personally. I would also tour the market and be able to endorse the acquisition from my standpoint, that it fits within our portfolio, not only from a return standpoint, from a longevity and a sustainability standpoint within the portfolio. So that doesn't mean we're just buying off of returns today with a lease in place. It needs to last time, which means the release of the property needs to be as favorable as the lease today. So again, it's holistically looking at an asset from a long-term standpoint that would fit in our portfolio. And the reason why we've picked industrial, living sector, and retail is because we think this will balance the portfolio to make it more sustainable in good times and bad times.
Okay, related question on acquisitions. Can the acquisition mandate be fully funded through the disposal mandate without raising additional capital?
Yeah, so right now we're not asking for an EFR. And that question, the simple answer would be yes. However, it would be contingent upon what the disposal pricing would look like, and it would be dependent on which assets we sold. So depending on how you construct the three assets, and depending on how the pricing comes in, yes, it could be fully funded through the dispositions.
Do we currently have any indication on when the first acquisitions are likely to come in?
First acquisitions?
That's right, yep.
Not yet. We obviously need to get through. I mean, our number one focus right now is to pay the milestone money, as mentioned, the 56 million roughly to the lenders. Our focus is to get out of the MRA. We need to have that first disposition before we can then move to the acquisition. And that's why both these mandates are tied together, because you can't have acquisitions without the capital to buy those assets. And we're not disposing simply just to pay down debt. Now, we will pay down debt, part of the proceeds, but not the goal is to take a very balanced approach with this, to not only pay down the debt to get our gearing and our ICR in better shape, but in addition to that, to also be able to grow the portfolio too.
So since you mentioned that the disposals and the acquisitions are tied together, another potential suggestion is there any way that you can improve on your price to book valuation before pursuing further acquisitions?
Yeah, so if you're asking, improving, I'm not sure that question is, overall valuation of the portfolio, the individual valuation of the assets that we're looking to dispose of. And I guess in some respects, it's kind of the same. Look, we've been waiting a while as it is to see improvement in the office market. And, again, I can't go into detail because our valuations have not been completed. But, as we've said in multiple presentations, the tranche 3 is performing better than the tranche 2, and the tranche 2 better than tranche 1. So, there's no shock to see kind of how things are shaking out, given the fact that everything is ultimately tied to leasing and growth within the markets. So, some of these assets may take a very long time to recover from a valuation standpoint. And honestly, we're going to be missing opportunities in the market. And the other part of this too is, the new focused assets that we're looking at have much lower CapEx requirements. Office has a very, very high CapEx requirement. It makes it very challenging for us to see valuation increases, given the fact it's so expensive to do some of the leasing in some of these markets. In addition to that, as I've referenced in the past, the payback for some of these leases are very, very long periods of time. Now, look, we're not doing those types of leases because we've been capital constrained. So the leasing we've done has been very strategic. But, in general, the leases for office tend to be very expensive. And I'm not sure there's going to be any improvement in that in the near future.
Still on the point of acquisitions, this live question relates to, are we trying to diversify too widely in terms of acquisitions? Do we have the capabilities and expertise to manage diverse assets, both in terms of sectors and geographies?
Yeah, we absolutely have the expertise. The platform itself has the expertise. The other funds that sit on the platform have all diverse portfolios with the 4 product types I've mentioned. So office, industrial, multifamily, and retail. Not all of them have all 4. Some have 3 of the 4. Some have 2 of the 4. Some have 4 of the 4. But the platform, all our asset managers across North America are experienced with all product types that we've been discussing. Same with our transaction officers. My entire career has been based upon these product types. Not only these product types, but my background is acquisitions, dispositions, operations, asset management, leasing. I've done it all over the last 30 years, which is why I'm going to be very involved with every asset that we purchase to make sure it fits in the portfolio and it's going to perform the way we need it to perform.
How do you evaluate acquisitions? Is there any condition that acquisition is accretive to your distribution as well as net asset value?
Absolutely. Yeah, everything is going to be valued. Everyone is going to be modeled. So to walk you through to answer the question a little more granular, other than just simply saying yes, we're going to identify an acquisition. We're going to drop it into our portfolio model and see how it affects the portfolio model. So some of the key criteria that we're going to need to look at in that is it's going to need to improve gearing, it's going to need to improve ICR, and it's going to be able to put us on a path to sustainable distributions. And that's why I said before, it's not only about how the asset is performing at the time of acquisition, but it's how it is going to need to perform over the long haul to give us the surety and the comfort that we're going to get to a place where we can get back to sustainable distributions.
Okay, so if I were to then look at the overall plan, including the disposals and acquisition, how does the REIT manager evaluate the potential upside that might come through from the growth and value up plan?
I'm not sure I got the first part of that, but I think I did. So basically, again, every other asset class right now in the US, other than office, is seeing much better growth, much better valuation increases, much better leasing activity, and lower capex requirements, right? Office just happens to be, the one that's lagging behind everyone else. In addition to what will not change, even when office recovers, is it will still have the highest capex requirement. And if you think about it, if we're spending a lot more capex on having to do deals to generate cash flow, it's going to put a bigger strain on distributions, right? So, just to give the audience a little perspective, a 300,000 square foot industrial deal, first off, a 300,000 square foot industrial building is probably only going to have somewhere between 3 to 5% of office within the warehouse. And the tenant improvement that will more than likely be given, and again, we're going to take just an average building, assuming it's in pretty good condition. The tenant improvement allowance is going to be probably somewhere about $2 to $3 per square foot. So substantially less. And the interesting part about that is the rent, depending on the market, on a net basis, could be very similar to what some of our net rents would look like on our office buildings right now. And again, they're triple net leases, so there's no risk of any expense changes as it would affect the MPI.
Since you mentioned the outlook of commercial real estate in the US, can you maybe share a bit more about what is the general outlook for this sector? And I think a related question is, what is the current occupancy rate that you see for your portfolio?
Okay. See, let's start with the occupancy because I have those notes right in front of me. So right now, as of September 30th, our occupancy is about 68.2, which is probably similar to what it is right now. It hasn't really changed. So we're at 68% occupancy. So if we run through the individual properties, 865 Fig is at 45.6. Michelson is 81.5. Exchange is 74%. Penn is about 90%. Phipps is 83%. Centerpoint is 75%. And Diablo is about 38%. So that's our current occupancy. What was the other part of the outlook on the other assets? Was that the
Yep. Outlook on commercial real estate. I think you briefly touched on it earlier. What are we seeing in terms of the trends within the industry?
Yeah, so I mean, the beauty of what we're trying to create here, and the reason why we've also included Canada, is it gives us a lot of flexibility. I mean, the United States is a huge real estate market, right? I mean, we could spend all day talking about just the US alone. You have assets that, I mean, we have three different product types, right? So maybe I take a moment and just talk about that. So we picked the three product types for the reasons why we mentioned. Again, it gives us flexibility to achieve the best portfolio construction that allows us to have a more sustainable portfolio that's more resilient to the ups and downs in the market. I think the overall, if you were to ask me just from if I had a blank slate on what I would create with portfolio construction at this point in time, it would probably be an equal amount of industrial and living sector with a little retail and a little office. And the little office would more than likely be one or both of our tranche three assets, and then a retail asset to round things out. And then the majority would be split between industrial and living sector, otherwise known as multifamily.
So this question by William, you mentioned the four sectors. Do you have a ideal stabilized asset mix between these four different sectors?
What was the question?
Mix asset allocation.
I think that's what I just mentioned.
Any percentages that you can share?
Okay. I mean, so it would probably be 40% industrial, 40% living sector, probably 10 to 15% office, and maybe 5 to 10 retail. So again, if you were to take the majority, so take 2/3 roughly, if not more, split that equally between industrial and living sector, and then a small piece of office and a small piece of retail is pretty much the construction that I would see. And again, that's purposely built that way to create the more resilience within the portfolio. One thing to think about that's kind of interesting is that COVID is what created the issue with office, right? I mean, that clearly created the problem during COVID and post-COVID. It created the issue with office real estate. So on the flip side of that, if you go back to during COVID and post-COVID, industrial real estate had never performed better. Values were through the roof. Rents were through the roof. It was off the charts. Demand was off the charts for industrial real estate during and post-COVID. So if our portfolio would have simply been balanced with industrial and office, we would have weathered the storm just fine. In fact, we would have been neutral, probably slightly to the positive, if we would have been balanced with industrial. So again, that's sort of what we're looking at here when we talk about a diversified portfolio, except we're going to take the diversification a little bit further and have living sector, industrial, some office, and a little bit of retail.
Okay, and I think relating to that, which REIT in the US would then be your closest comparison, based on the segmental breakdown that you shared on the restructured REIT?
Yeah, I don't know if I can name something off the top of my head. I mean, there's a few privately traded REITs that come to mind. DWS has a privately traded REIT that's called REIT America REIT 2, but it's not publicly traded. They take the same approach on how they look at these things. Again, we have an in-house market research department that creates house views. They do mid-year and end-of-year. They lay things out. Every portfolio looks to that as far as guidance on where you want to be, where the emerging markets are, which states, which submarkets you want to be, and you're constantly rebalancing your portfolio to create the best sustainable MPI possible.
Okay, I think one of the segments mentioned was the co-living sector. So I think this point by Naresh, that there seems to be some pushback against big funds and REITs owning residential sector assets. Why go into this segment?
I'm not aware of pushback in general. You know, the living sector or multifamily sector is probably one of the hotter sectors in the U.S. It's also one of the sectors that is the easiest to get financing for right now. And at some of the most attractive rates, because there's so many lenders that are willing to lend on most lending sector product that it gets very competitive. So the rates are quite good. The spreads are pretty compressed on those loans. Now, maybe what this individual is referring to is there are certain states that you want to try to avoid. California, where I live, happens to be one of them. There's a lot of government oversight on this, or otherwise known as rent control, and that is absolutely one that I think lines up quite well with the comment or the question that you mentioned, but that is not representative of the entire United States. In fact, if you were to go across the entire United States, there's probably one or two or three states. California is probably one of the worst. New York City would be another one. But even within the entire California, there's probably some submarkets that are not nearly as affected. You know, San Francisco is very bad. Santa Monica is bad. I mean, we can get into very granular here, but in general, it's not an issue. I mean, multifamily, you know, there's a shortage of housing in the U.S., right, in most of our markets. And so, you know, the product that I would more than likely avoid would be luxury, you know, housing, because that's sort of at the top of the tier. It's your most expensive. It's your most expensive to buy, the most expensive to build. You know, we kind of like more the mid-tier, which is called workforce housing, which is right in between. And there's always a demand for it. There really is. In most of the markets that we've tracked, we've seen rents that are pretty consistent. You know, the weaker pieces of the segment is more on the luxury housing side.
Since you shared many different segments that the REIT manager is exploring, this question by Bernard, any consideration to explore data center investments?
I'm sorry, can you refund that question? In consideration, 6-4 data. Oh, yeah. Yeah, no, I mean, data centers falls under industrial for us. So to be clear, under industrial, you know, the categories that would be underneath industrial would be a data center, cold storage, IOS, which stands for industrial outdoor storage. And then amongst industrial, you have big box, you have small bay, mid bay. There's a whole variety of product there. You know, again, as we enter into the growth and value up plan, the goal is to create sustainability. And so we would probably try to avoid any single large tenant exposure. You know, so for example, if we were to buy a 200,000 square foot industrial building, I'd prefer a 200,000 square foot industrial building with 10 tenants than one with just one tenant, because I think it exposes the REIT to way too much risk if there's any collection issues or anything goes wrong with that one tenant.
Okay, and maybe just to play devil's advocate, this question by Jeremy, and going back to the office sector, we have seen the cap rates falling with the decline in interest rates. Back to office is increasing. Would this actually not mean that we should continue to focus on the office sector?
So that's true. All those comments are absolutely true, except for the fact that it's moving very slow on the office side. And you know, some market like we've talked about in the past, like Phipps is doing pretty well, Michelson is doing pretty well, Diablo, ghost town. We have no leasing activity there. It's very slow. So not everything is equal. I mean, that's the one important thing is, you know, the US is so big and so diverse. even within the individual states, the submarkets are very diverse. In general, I mean, look, office for the most part is going to recover, but the way the recovery is happening is it's happening at the top. So the true trophy assets, or the tier one, depending on who's coming up with the terminology, but it's basically the best of the best. And that's usually an office asset that's been built in the last 10 years. It has all the bells and whistles, meaning there's amenities, there's a gym, there's a conference center, there's public transit that's close by. It has everything that everyone wants to ask for. That product's doing pretty well. And those cap rates have absolutely compressed. But again, the reason why they've compressed is because the leasing demand is good. The leasing demand is strong. The returns on the deals are much, much better. So that product's doing really well. Now, the good news is we're at a point in the cycle where I think that top tier is getting a little pricey. It's getting a little saturated. So in anything, there's sort of a flow down or overflow effect. So it's coming off of the top and it's going to the next tier, right? Now that tier needs to experience what the top tier has experienced, which is going to take time. Now the good news for us is we're kind of, that next tier down is kind of where Michelson and Phipps sits in. So we're benefiting from that spillover effect, as I've referenced. But there's a lot of square footage in that next tier, right? So that's going to take time for that to get saturated. That top tier is one of the smallest from a square footage standpoint across the country. So it didn't take a whole lot for that to get sort of filled, so to speak. So now we're moving to the next level. The next level is going to be our tranche 3 assets, but that is a much bigger sort of square footage that covers the US. That'll take more time for that to fill. But once it does, it'll then move down to the next level, which would, if we follow the math, that will be our tranche 2 asset. So that's sort of the progression. But as you can imagine, that could take quite long. Now, if we continue to see interest rates cut, that'll improve. But there's not always an immediate reaction to every interest rate cut that occurs. Because remember, that's only one piece of it. We need leasing activity to pick up. It's when leasing activity picks up, interest rates come down, institutional buyers come back to office, lenders continue to want to lend on office. That's when things all start to hum along and things start to improve.
Okay, the next few questions relate to capital. I think earlier you mentioned that this mandate isn't one requesting for any equity fundraising, but how do you think about potential further equity fundraising down the line? Whether is it for the acquisitions or whether is it to pay shareholder loans?
I'll let Mushtaq take this one for a moment.
Yeah, so I think it's a great question. Basically, how would I answer? At this point of time, the fundraising is not contemplated in these mandates. And the reason is that at this point of time, where our unit holder or unit price is, we believe that it's not in the benefit of the REIT and the unit holders to issue more units because it would cause dilution. But as we dispose of assets and we make acquisitions, what will happen is that it will change a few things. With the change in the mix in the portfolio will become more resilient and refinanceable, which will allow debt refinancing. But at the same time, it will allow more prospect of growth to the REIT. And with the new acquisitions, when we have growth in when we can expect the portfolio value to grow, at that time, our unit price will get the support and it will uplift. And that will basically be the right environment or condition for an equity raise. So while the equity raise to be done at the right time is very important for preserving the value of our unit holders, we would tie it to the growth of the portfolio as we go along. So that is why it is not right now. I think there was a second part. Did I answer that, or maybe just remind me if I haven't?
Yeah, so I think that one relates to not just for acquisitions, but also any fundraising to repay sponsor loans.
Yeah, so as I said, it's all tied to the part of this growth and value up strategy, because this growth and value up strategy will first allow us to diversify our assets. When we have a mixed portfolio, it has a better prospect of getting debt refinancing, which will then basically pave the way for any refinancing, including the loan from the sponsor that was taken 2 years ago. It's basically these sectors that we have identified, as John also mentioned earlier, are much more in a better position to attract attractive financing than what we have right now.
So let me just add to that. Can you scroll up for a second? All right there. So this question is very specific, so I want to answer it directly. So the sponsor's loan, their expiration is the last to be paid back. So just to be clear on that. So that this question is very direct to repay the sponsor's loan, which is not the intent to go out of order as far as expiration. So that when the sponsor made the loan, they intentionally were at the end of maturities, meaning the last maturity.
Okay, since we have answered the part on capital raising, the next part is on distributions, which is what many unit holders are looking at. Is there any plan to then be able to resume the dividend payouts?
Yeah, so with the distributions, currently we are under the MRA, and one of the conditions under the MRA is the distributions remain halted under we meet all other conditions of the MRA, or what we exit from the MRA. So the first prerequisite is to manage that, and the distribution mandate will help us obviously in the next 6 months as we look to divest one more asset, complete the minimum sales target that is required. With that, when we start the acquisitions will provide the portfolio more sustainable cash flows, because these investments will be in those sectors which will be less prone to capex investment as opposed to office. So we are looking for that stabilization and sustainability of cash flows in place as well as soon as we can. So that will basically give us the required prerequisites to resume distributions. And what we want to make sure is that when we start distributions, we want to do it in a sustainable manner, and obviously as soon as possible, which is would be with the cash as we improve our cash flows.
Do you have any planned timeline for that?
I won't be able to give a specific timeline because it depends on how soon we are able to dispose and then also start our acquisitions. But what I can say is that unit holders do not have to assume that they will have to wait until the very end of everything. It will be a timeline, or a timeline for us is that when we see that we have put ourselves on the path of growth and we have the sustainable cash flows to do it, we will do it as immediately and urgently as possible, because it remains our key priority.
Yeah, and to that note, when we look at an acquisition, one of the components, as I mentioned before, in the acquisition is how is that acquisition going to help us get to that point of creating sustainable distributions?
So I think with that, we have covered most of the questions. I think just want to round up, given that quite a lot of the initiatives are intended to win back confidence amongst investors. Maybe can you just sum up what is the roadmap over the next 2 to 3 years, including the current plan that has been announced, to be able to do that, and what are some of the benefits that can then be accrued to unit holders?
Yeah. So as we've laid out, we have the growth and value up plan, and the part of this is, ideally provided that the markets cooperate with us and continue to improve, would be to sell assets that we currently own that are underperforming and that we don't see opportunity for any real future growth in the near term for those assets. So that is the real focus. So removing those assets from the portfolio will not only generate cash to pay down debt and for future acquisitions, but it'll actually improve the overall performance of the portfolio, right? Because that asset's just taking space. And if we can replace that asset with a higher performing asset that has better MPI, it moves us in the direction of where we need to go to. So depending on how the market recovers, we envision, that this mandate goes to April of 27, which is aligned with the AGM that we would have in April of 27. So that is the goal, to be able to accomplish what we've outlined in that period of time. There's a chance that we may not get all the way through, which is why it's been aligned with an AGM in case we need to request an extension to finish the tail end of what we're working on. But ideally, again, if the markets continue to improve and we see interest rates continue to come down, that should give us the ability to accomplish what we've outlined here.
All right, so with that, we have come to the end of today's dialogue. A big thank you to John and Mushak for your time today, for giving us the answers to the questions that were asked. A gentle reminder to all unit holders that the EGM will be held on the 16th of December, that's a Tuesday, 2 p.m. at Stephen Riadi Auditorium at NTUC Center, Level 7, 1 Marina Boulevard. Do save the date, and we encourage you to attend the EGM to cast your vote on the proposed mandates. Should you have any further questions, you may reach out to the Investor Relations of Manulife US REIT, and I'm sure the team will be happy to assist you. Thank you once again for joining us today, and have a good weekend ahead. Thank you.
Thanks, everyone.
Thank you.